our estate planning for doctors webinar. Thanks for joining us. We still have a lot of people who are going to continue to join us, but we want to start on time and make the most use of our time and get as much information out of our speakers as possible. I'm Cindy David of Cindy David Financial Group. I'm your host and moderator for today's session. I'm a specialist in financial and estate planning with 30 years of experience. Yes, I started when I was 12. I am recent past chair of CALU, the Conference for Advanced Life Underwriters. While serving on that board, my legacy there was that we successfully passed Bill C-208, which is legislation for tax fairness for family business owners. We have almost 50 registrants from BC, Alberta, and Ontario, which are all provinces that I'm licensed to give advice in. Today's session will be an informal fireside chat versus a formal slideshow presentation. So the meat and potatoes is really in what our speakers are going to say to you today. The recording or the session will be recorded, so we'll be sure to send it to all registrants and those of you who maybe are joining late or not able to join at the last minute. Each speaker is going to have 15 minutes to cover a variety of questions that I have for them. And we will have a question and answer period of about 10 minutes at the end. So if you have any questions along the way, please go into the Q&A section, not the chat section, to post any questions. And we'll address as many as we can. If we run out of time, we will get back to you one-on-one. So without further ado, I'll introduce our panelists. Lori Pinkowski is a senior portfolio manager and investment advisor at Canaccord Genuity. She has been successfully managing money for almost 25 years, and she's one of Canada's top wealth management teams in the country. She has a weekly radio show called Making Sense of the Markets. It airs on CKNW. She's been doing this for 15 years, and it currently runs at 8:35 a.m., which is Pacific Standard Time, on Wednesday mornings. If you want to join her and get her advice on a weekly basis, that's how you do it. Lori sits on the board of directors for the Ronald McDonald House, BC and Yukon, and was just appointed to their finance committee. One of Lori's favorite quotes, which I'd like to read to you before we get started, is, "When driving on the track, you need to be prepared for what's coming around every corner, even if you can't see it coming. It's imperative that you make quick yet calculated decisions while behind the wheel or in the markets." Our second speaker is Troy Melnichuk. He is a partner in tax services at Grant Thornton and has been with them for the last 13 years, advising private businesses as they navigate Canada's complex tax system. If you are a hardworking business owner and operator, he's the guy you want in your corner, helping you with complex tax work, which can significantly affect your bottom line. And that's kind of why we're all here today. He also spearheads a really unique program at Grant Thornton, which is called the Private Business Growth Award. It's a national award recognizing independent business success stories across the country. Our last speaker, last but not least, is Michael Scott, who is a lawyer and partner at Clark Wilson in their estate planning and administration department. Michael prides himself on being able to give you advice so that you're better informed and able to make really difficult decisions when it comes to estate planning. Avoid the infighting is kind of the motto for a successful estate plan there. He's passionate about helping his clients simplify the complex legal principles. And I think that's really key, is finding advisors. And this group of advisors is really good at making things make sense for you. And hopefully we can do that for you a bit here today. Michael takes a team approach. So I think we can all say that we're on the same boat here. Is most people joining us on the call today already have a team of advisors, and sometimes you need a specialist to step in, and we're happy to work as a team with your existing advisors. Michael can also help you with estate administration issues, such as issues that might come up with the probate process, ambiguous wills, or assisting your executors and trustees in their reporting obligations. Without further ado, we'll get to our first speaker, Lori Pinkowski, who is no stranger to the camera or speaking publicly. Lori, let's start with a market outlook for 2024. We're all investors in the room, and I think it'd be really great to hear what you're anticipating for the year.
Yeah, I think it's, well, hello everyone, and thanks Cindy for putting together the webinar. I think there's going to be a lot of good and useful information here today that we're sharing with our listeners. So in order to kind of update people about the markets, I think it's important to also just quickly chat about where we just came from. Obviously, we are coming out of a bear market. Whether we're in the early innings of a bull market or a good market is, you won't know that for a year from now. However, you know, bear markets typically last 1 to 2 years. That's what we saw. Obviously, this was due to high inflation and interest rates. And you know, as of kind of late last year, we saw things really start to change. And I think that's really important for investors to look forward and not look in the rear view mirror as, you know, what has happened. It's important to look at what is happening currently. Make sure that you have an active investment strategy, because anything can come out of anywhere, as we know, and just make sure that you're positioned for the current market conditions and what we see happening moving forward. So with the first slide here, what I want to show is kind of where we are at today. And so this is just kind of referring to unemployment in the US, basically, but also in Canada. Historically low levels is what we're seeing. And that's important because a lot of people, a lot of economists out there were expecting a recession last year. And of course, we didn't see a recession. Markets moved further, higher, although a lot of people got spooked about the idea of a recession. And so you can't really have a recession when everybody is working and employed. And so that is one reason why we've sidestepped that. It has ticked up slightly. However, still, you know, what we're seeing in the US, unemployment at, I think it's 3.9%, that's still 40, 50-year lows. And so we're not seeing that tick up immensely. And even if it does tick up a little, that's something, again, we're watching as active managers. And so with the next slide here, we have interest rates. And so interest rates rose at the fastest pace in history. And again, this was all due to high inflation. You know, with Russia invading Ukraine, we saw oil double in price, and we saw inflation take off like a rocket, and interest rates followed. And the Fed increased 11 times. The Bank of Canada increased 10 times. So, you know, if you're feeling these interest rate increases or your adult children are, you know, this is a conversation Cindy and I have often with clients regarding, you know, should you be paying off debt? Should you keep it? You know, my adult child, you know, needs to buy a house. Should I help them? Should we get a mortgage? All those sorts of things are things that we plan for and we talk about. So interest rates are expected to decrease this year in Canada, and that's important for us as Canadians, those of us that have debt. What's important for your portfolio or for markets is the US and the Fed decreasing interest rates. And the expectation is that we're going to start seeing lower rates mid-year, you know, June, July, September. However, when inflation is still not at target levels, that kind of gets pushed down the road somewhat. And so when we're looking at inflation, you think about, again, where we came from. In the US, we're over 9% at one point. We're just at 3.2% now. Canada is under the 3% mark, so it's almost within target of that 2 to 3%. However, they like to see closer to 2. So we likely will see the Bank of Canada reduce rates before the US does. And so that's another reason to me for markets to move higher. And I'll talk about that in a moment. And so if we take a look at the next slide, this is another reason why we've seen markets continue their momentum. When you see earnings improving, and we were in an earnings recession where year-over-year growth was negative for a lot of companies who were reporting, except for maybe, you know, in the tech sector. And so now we're starting to see that change and evolve. And it's really important for us and the portfolio management team and for investors to see that change. And so we're seeing improvement in earnings almost across the board. And I think that that will also continue moving forward. And again, you have to be careful of what sectors you have exposure to. Not all sectors are created equally, whether it's, financials versus energy positions versus technology versus real estate. So it's really important to have that active investment strategy so that, again, your team, your financial advisor is staying on top of it. And I'll talk about buy and hold versus a more active investment strategy in a few minutes. Next slide, please. So this is a question I'm getting a lot, almost at every review that I'm doing with clients, is that, oh my, it's an election year in the US. What is going to happen? And typically markets can be slightly volatile leading into that election period, maybe a month before. Almost always do markets move higher after the election, no matter what party is voted in. And this slide kind of says it all. 82% of the time markets have been positive. So again, you have the momentum of earnings right now. You still have low unemployment. You have interest rates are going to be declining, and you have an election year, which typically is good. You also have a bear market that did last 1 to 2 years. And so again, coming out of that. And just remember that the first year to 3 years coming out of a bear market can be very, very strong. Next slide, please. So this is showing...
I like any charts that go up in directions. So this is looking positive.
Up is good. Like my son says, green is good, red is bad. And that is true for the stock market. He learns young. In terms of when we're looking at the S&P 500, so this is again a chart of 500 companies in the US. You can see how it's broken out. So it moved higher, advanced further than its previous high. And again, this is when everyone's talking about negative things still. And usually when a bull market starts or markets start to recover, again, people are looking into the rearview mirror going, oh my God, this just happened and markets were down. But markets turn, and when they turn, they can turn with a vengeance. And that's what you've seen. And so this is, again, the S&P 500, which is a little bit, well, not a little bit, a lot overweighted to what we call the Magnificent Seven stocks. And so that was the Apples, the Amazons, the Googles, the Microsofts of the world. And now they're talking about the Fantastic Four. So, of course, that's changed. Tesla got booted from the list because they're down this year and so on. And there's a few others. So what we tend to look at now is more the equal weight S&P, which is on the next chart here. And what this is showing us is if all of the companies in the S&P 500 were equally weighted, what does that look like? And I think that's more important to really give us an idea of what's happening in the economy, what's happening with these companies, what's happening with the index. And so if you go to the next chart, this is
Lori,
showing...
on that past chart, if we can just go back to that past chart, you know, one thing that I would highlight here is if you held a ruler up to it over the last couple of years, it would be a flat line. So there's a lot with a lot of volatility. So, and I know you're going to talk about this, but I just want to highlight that for our viewers so that you're aware that it's really important to actively manage a portfolio. You can't do the George Foreman and set it and forget it anymore, because you could end up just in a long cycle of not really making money, but still having a lot of volatility in your portfolio.
Yeah, I often say that the slogan from AIC back in the 90s, buy, hold, and prosper, you know, since 2000, if you have that strategy, it's like buy, hold, and hope for the best. Because you do need to be actively managing these markets. Things are changing. You got to be on top of it. I say the world changes and you got to change with it. Otherwise, you get left behind. So that's fundamental to our strategy. And so what this is, again, just showing you here is that for a while there, the S&P 500 was really outpacing. You can see in 2023 there. I don't think I can point to it, but if you look at 2023, you can see the purple line moving higher, while the orange line is kind of bouncing around, but really didn't go anywhere until the end of October and beginning of November. And this is what's so important about this recovery, or again, the early innings of a bull market, is the S&P 500, the purple line there, again, has the Magnificent Seven, or again, overweighted the tech sector. And so you saw that those stocks moving higher, and they make up about 30% plus of the S&P 500. So most people don't just own those 7 stocks. They own a diversified portfolio. And so you may have noticed that, you weren't going anywhere quickly in the first half of the year. However, after November, the whole market started to take off. And that is what is important of this recovery and this change in markets. So what can push markets higher besides them lowering rates and good earnings? And this happens after every bad market or bear market, is the amount of cash sitting on the sidelines. So there are a lot of people out there who get spooked with markets, and they saw GIC rates at 5% and thought it was a great idea last September or October to sell out of a portfolio and buy GICs. Well, now the markets have recovered 15, 20% or more. And that wasn't the best idea. However, when you look at how much money is still sitting on the sidelines, it's a huge number. You're seeing $9 trillion sitting still in cash or short-term money market type deposits. And what happens after a bear market is historically that money comes back to work. Maybe not all of it, but a big portion of it. Because as rates go lower, people aren't getting that 5% anymore, right? So they're getting 3% now. And you take tax into account, which accountants will agree, interest income is no good. Your 3% is really 1.5%. And so there's a time, see, there we go. We got thumbs down from Troy. So there's a time when that cash is coming back to markets, and that is essentially what can push markets even higher than you and I expect. And I do get a lot of people saying, Lori, markets are at an all-time high. Just remember that in a bull market, markets are always hitting all-time highs, right? And bull markets tend to last 3, 5, 10 years. So I don't want to say that there's absolutely no risk in markets. There always can be, things changing. And again, we're on top of it. And we have a much more active strategy than most in terms of our portfolio. So this is, when I talk about active management versus buy and hold is if you just, bought a basket of stocks and held on to them and hope for the best. For us, it's important to make insightful decisions. I've got analysts on my team. I kind of manage my business like an investment firm within the firm. And we're taking a look at daily what's happening to our positions and what we should be doing. In terms of Apple, this is one of the companies that we own. It's in the news quite a bit lately. And this is, again, a company that we bought and then we sold. And it's important to take profits. Just because it's Apple doesn't mean that you have to own it continuously at all times. And so what we started to see is that their revenue wasn't going, sales were dropping off. And so we decided to take our profit at $188 a share. And since then, it's fallen back to $173. And there's still some news surrounding it. And so that's not a company that we're going to buy back anytime soon. However, in the future, it's still Apple. It's a good company. They, a good balance sheet. However, we think that there's better horses at this time. And so Apple is a good example of something that we bought and then we sold and took the profit on. And again, the buy and hold here, again, isn't just, you don't want to own any position blindly. Let's put it that way. Next chart there, please. So again, this is a kind of, sorry, I'm just going to move your beautiful faces. So again, this is kind of a longer term chart, just again, to show the volatility of a stock like Apple. So it's not that it just always increases. And I would say that for every stock, there's things that become in and out of favor. Oil is a big one, or energy stocks. You shouldn't just blindly be owning something. And also don't be owning something just for a dividend. I think that's also important to mention. A lot of people love BCE because it pays a big dividend, but you look at the stock and it's gone nowhere, and earnings have been lower, and so or TELUS or some of these other ones out there, and Bridge, and so it's important to pick stocks and be a good stock picker in this environment. You don't want to just always own the index blindly.
What about the Canadian banks, Lori? I hear often a lot of clients who think as long as I own a good basket of these blue chip banks in Canada, I'm going to be okay, and I'm just going to hold on to them forever, and eventually it's going to pay off. Could you speak to that a little bit?
Yeah. Investors, especially, Canadians, love their banks. And, we had banks report a mixed bag. Some beat expectations, some are lower. And then when I'm looking at, which banks to own, and should we, again, it's the allocation to the financials is what we're looking at when we manage money like institutional money manager. So if we want 10% in financials, because we think they're going to do well, where do we want to own? JP Morgan was one of those decisions during the banking crisis last year. Again, looking at some of these corrections or mini crashes, even in a sector in the markets, you want to try to change the way you feel about that and look at that as an opportunity. So when some of these smaller banks were somewhat failing, and other banks were taking them over, if you're in America and you're going, I'm worried about my local bank, I'm going to go to the biggest bank. You go to JP Morgan. And in Canada, so we own Royal Bank, for example. And so we bought those financials during that situation. And so we continue to hold them. However, the Canadian banks do worry me somewhat because of the exposure to real estate, their exposure to obviously mortgages and loans. We've been seeing Canadian banks putting more money for loan loss provisions on the sidelines. And again, that is, to have some cushion in case more people are walking away from their loans and mortgages. So I think there's more risk in Canadian banks.
Segue into my next question for you, actually.
Go ahead.
Real estate or stock market? There are a lot of Canadians who are really battling with, I've made a lot of money in real estate. A lot of my wealth has been because of our really strong real estate market. Maybe I don't trust the stock markets. Real estate or stock market at this stage in the game, given what we know and where we're at, where we are in the market?
Yeah, I mean, I believe in both. However, we have to, look at where we are in the cycle. And I come from a real estate family. My mother's a realtor. And I've bought and sold a lot of real estate in my lifetime too. And I advise a lot on it on CK&W. So we're always up to date with the numbers. And so this just shows you the stock market versus real estate. And it just shows how, if you look in the 80s and, 2000s, early 2000s, you can see those big U's on that orange line. And that shows how long a real estate bear market can last. And, what we saw is the real estate market, so it peaked, and you've seen sales really falling off, especially in the lower mainland here. Even over the last 6 months, we're seeing listings move higher. I think there's more of that to come. I don't think that just because they reduce rates, remember when they reduce rates, they're not going to be reducing rates back down to 2%. They're going to be reducing interest rates by a quarter point, maybe per meeting. So again, we want to be mindful of that. So I don't think people are just going to be jumping on the real estate train over the next 6 to 12 months. It's going to take more than that. And then remember, people are leveraged, up to the hills. A lot of people lines of credits against their homes, to finance a new car is more expensive and so on. So over time, the stock market has outperformed real estate. And I think that's important to look at as well. This actually, and we couldn't find the perfect chart, but I wanted to include the 80s, which is actually more significant. So if you look at like the last 50 years, the stock market has really outperformed the real estate market. This shows from 97 to 2022, basically. And, it's showing that the markets have outperformed 8% to Canadian real estate, Vancouver 6.5%. A lot of people wouldn't even think that is the case. And some people love their real estate, Cindy, as you and I sit in a lot of meetings. They like to, hug and touch their properties. And in the stock market, you can't do that. But just remember, the stock markets, have bear markets and they peak much, much more quickly and then move higher than real estate bear markets do. And so going forward, again, I believe the stock market is at a really good part of the cycle. And I don't think that this momentum is ending. I feel like it's just beginning. So I think there's a lot of upside to be had. And I don't think people need to be as nervous about markets as they were. And I think it's still important to have some real estate. But again, having a portfolio allows you to have more flexibility, especially as you enter into retirement and you're able to use those funds to fund life. So again, I think there's a happy medium, which I'm sure the others will touch on.
Yeah, and I would say, from a financial planning perspective, what happens in retirement is you need to spend some money. You need to have retirement income because you're throwing in the towel on your paycheck. So where is that income going to come from if rents aren't enough for it? So sometimes liquidating is is what we need to do and create an investment portfolio to feed the retirement beast. I feel like I've retired several hundred times in my 30 years. So it can be a really stressful time for a lot of retirees too, if you're just thinking about that now. And the other thing is not everybody wants to be a landowner beyond age 65 and all the headaches that can go with that. So I can see there's been positives on both sides. Thanks, Lori, for giving us your insights. We're going to move on to Troy here and tax talk. So gosh, I get really excited about this stuff. Troy was like, I'm not sure, people are going to get as excited as you are, Cindy, but the tax stuff is so important because a big part of our mission in life is to put more money, keep more money in your pockets and grow your wealth tax efficiently and transfer your wealth tax efficiently. So I just love this part of the conversation. And with Troy, I'd like to focus on, well, for starters, what are the most common mistakes that doctors make or planning opportunities that you see them maybe missing out on and not taking advantage of?
Great question, Cindy. And hi, everybody. I would say this is that for the most part, in my experience, doctors are very, very busy and they're doing very, very important things. And so like saving lives, which is very different than the things that financial folks do. Also important, but just different. And what I find most often with the doctors that I help is that they tend to be leaving things off to the side a little bit when it comes to finances, and they tend to leave their books and records a little bit messier just because they just don't have time to address them. And so that just makes it a bit challenging to kind of pick up the pieces and make sure that we're doing everything right for them. I would also say that, generally speaking, because they're busy, there's just this generally a lack of a planning that they would do, just because, again, they're focused on other things in their lives and they're not necessarily focused on the financial matters. Like, what am I going to do when I retire? And
retiring doesn't happen overnight. It's a process, and something where conversations need to be happening, I think, in a healthy perspective, 2 to 3 years, maybe even 5 years in advance to really be looking ahead. I think that's important. It's a really good point.
And I know, like, for example, Cindy, like my own doctor, she often says to me, like, oh, I'm going to keep working beyond 65. I want to keep working. And I think that's very common for doctors, is that there's a desire, they're professionals, their knowledge just doesn't disappear and they love what they do. And so there's a lack of desire to kind of plan for these things. They just want to keep going. And so it's a very natural thing for them to want to do. And I think that's just, it's very common.
So if we could motivate all of our doctor clients to spend the time planning ahead, how often do you think they should meet with their advisors? Or, it's kind of like, how often should I get my teeth cleaned? But how often would you say they should be meeting with you, sitting down and getting proactive advice, which is hard to come by in your profession these days?
Yes, lack of resources. That's fair comment, Cindy. I would say at least annually. There's a lot of things that are going on from a legislative perspective. A lot of things that change in their lives, and they really do need to be thinking about this on an annual basis. It's no different than will planning, like checking in and making sure those things are happening on a regular basis. Understanding your tax structure, understanding what's going on. Things that may affect you, that you may have to pivot and change because of this constant change of legislation that we're having is very real right now. And so it's very, very important. And, I know we like to try and meet our clients off cycle, just because after year-end cycle, that is, and just say, what's going on in your world and how can we help a little bit more, just thinking ahead. And so it's really, really important that doctors do that as well and make the time to do that.
So, and not just talking about getting your filings done and on time, but actually spending time having meaningful conversations about what's going on in your life, any life changes. Are you thinking about retirement, or maybe you're already in retirement, but really starting to think about, do I have all my ducks in a row when it comes to my estate plan?
Yeah, absolutely.
We have had a lot of legislative changes when it comes to tax. Specifically 2018 was a big year for Justin over there in Ottawa. I made a lot of tax changes that really affected doctors and business owners, professional corporations. So I'd like you to talk, this is the sort of the more technical part of the presentation with Troy. I'd like you to talk specifically about the tax on split income rules, or TOSI. I'm sure all of our people attending today have heard this come out of their accountant's mouth at some point, but maybe you don't really understand or have been too afraid to ask, what is this really and how does it affect me? So what is TOSI? And how does it affect my corporation, or how I can flow money out of my corporation, like dollars in my hands? There's a new thing called notifiable or reportable transactions that I don't think our clients are hearing enough about. We are certainly hearing about it on the professional side a lot. But this is an attempt from the government to know more about you and what you're thinking about doing before you do it. They're actually creating an obligation for you to let them know ahead of implementing plans. So I'd like Troy to talk about notifiable and reportable transactions. I think we've all, as Canadians, heard of GAR, the General Anti-Avoidance Rules. But what I would like you to talk about is new GAR. What the heck is new GAR? And if you are a client or an investor on the session today, you've probably heard of GAR, but now there's new GAR. So Troy's going to talk to you a little bit about all of that. And that's a mouthful, but I know you have some slides on this to keep us on track and make sure we cover all of those points.
All right. Thanks, Cindy. Yeah, and this stuff is can get pretty technical, so I'm gonna kind of try to keep it at a high level for the conversation today. We'll start off with talking about TOSI, and then we'll end off with what I like to call the tax pirate, the GAR rules, and maybe talk a little bit about just what some of the changes are. So just going back to TOSI, or tax on split income, and Cindy, you kind of touched on this. 2018, there were some big changes to all private business owners in Canada. And not that this was targeted at professionals, but it sure felt like it was targeted at professionals. And doctors are square in that fold, and so are people like myself, who provide those services, and perhaps some of my guest speakers as well today. So this is something that is very real to all of us. I would say it impacts everyone, and what the legislation was trying to do was prevent what we call income splitting, which was a very common thing prior to 2018, prior to these new rules coming into force. And effectively, what this was meant to do was, when a taxpayer could pay their spouse or a family member who wasn't necessarily involved in the business, and have them taxed at a lower rate versus having it all taxed in the higher rate income earner. And so this was common practice, and it was something that was done for forever. And the government felt that was unfair and wanted to really put a stop to that. So they introduced these tax on split income rules. What you'll see on the screen here is just a classic example of a typical structure for doctors that have a doctor co in place. And we've kind of put the two side by side to show an example of one with a holding company, which is often the case where there's enough capital built up in the doctor co, and it's moved to a holding company to reinvest, perhaps with Lori. And that gives you a sense as to what that looks like. Maybe next slide. So this is a good example of how TOSI would apply. And it's a simple scenario, but it would effectively mean that if a dividend was paid from your doctor co up to your holding company, and then you paid a dividend up to the doctor and the spouse, essentially the spouse would have these TOSI rules apply. And what that means is that spouse would, instead of getting the gradual rates that we get in Canada, they'd be taxed the highest rate on that income. So it really was meant to deter people from trying to push income from one person to another to try and take advantage of the different rates we have in Canada. So this
that
example
can be a big difference. Just to put some meaning to that for our viewers, The difference between getting access to graduated rates on an amount that you would normally pay your spouse from your holding company could be as north of 30%. So that's a lot of difference in the money in your pocket.
Yeah, thanks, Cindy. And I think, so this is an example, one that's paid up through your doctor code to your holding company and then out to the doctor and their spouse. The tax and split income rules would apply to the spouse on that income. Conversely, if you look at the previous diagram that we had, if it was just directly owned in the doctor company and you had a dividend paid,
Yes.
it would apply as that in that scenario as well. Maybe next slide.
So going next.
So this is just an example just for numbers, because I like to think in the world of numbers. And this kind of gives you three different sections here and looks at on the first one on the left-hand side on the income sprinkling. This is kind of pre-TOSI and what the results would be. So if the doctor was taking a $300,000 salary and we were to pay a $50,000 dividend to the spouse, effectively, if you work your way down to the bottom, the net cash after tax in the family's hands would be that $234,000 number. And if you move over to the purple section, when the TOSI applies, essentially the after-tax cash in the family's hands is now $213,000. So it's a 20,000 ballpark-ish tax impact on that result. And that's
just on a $50,000 dividend to the spouse. So it's not like we're trying to overpay the spouse or equally split income. That's crazy.
And it's a big number. And so obviously as that number goes up, the tax number goes up. And essentially it's putting that individual as if that tax was basically put, or that income was put in the doctor's hands, for example. So the far right-hand side is kind of showing just that. It's saying, okay, well, if I just paid the dividend to the doctor instead of putting it in the spouse's hands, you'll see the numbers are exactly the same as if in the purple column. And that's what the legislation is trying to do. When you think about just from a planning perspective, it's helpful to know, like, if you're not drawing that much money out of your company, it still might make sense. So if you're below 300,000, let's say you're only pulling at 100,000 or $150,000 as a doctor, you might decide to pull out the dividend in your hands and use the rest of your brackets, and you actually might have a little bit of a tax break on that. So it's something you'd want to work with your tax advisor on, is just really looking at what makes sense for you, and with some careful planning, you can help mitigate your tax burden.
Can you talk just maybe briefly, I know we don't have lots of time, but what are tricks to mitigate that? What's a workaround? Could I pay my spouse a management fee instead of a dividend to avoid TOSI? Are there any ways where we can get around the TOSI rules?
Well, there are different ways to do that. I suppose the government's really tried to stop a lot of the planning around it. I should say, maybe, Cindy, one point to really point out is the one of the exclusions. So if the doctor has once they turn 65, they can start paying dividends to the spouse without TOSI applying on that dividend. And so one of the planning things that we'll often think about is, okay, as a doctor's approaching that age, we want to be thinking about, okay, they're going to continue to operate and we can start paying a dividend, but the key is the spouse has to be a shareholder to be able to do that. And so it's really planning ahead to understand, when is the right time to bring a spouse in as a shareholder if they aren't already there. And that's something, there's a lot of considerations, not just tax considerations, but it's something that you should be thinking about, and again, talking to your tax advisor, because that's a really good way to help reduce your tax burden once you turn 65 for the family, because you can really take advantage of that. And a lot of doctors will be in that boat in the future.
So key words to take away there when you're having that discussion with your accounting professional is you want to be talking about the flow of incomes and possibly a corporate reorganization. You can reorganize the shares of your corporation without any tax implication of doing that, but gain access to better income splitting beyond age 65, as Troy was saying. Moving on to reportable and notifiable transactions, give us the scary news.
Yeah, this is a fun one, and I would say I've just kind of showed one slide here. But essentially what the government has brought into force, and they're already in force now. We're kind of showing the two columns there, reportable transaction and notifiable transaction. And reportable transactions are really meant to, if you hit certain conditions or hallmarks in a transaction, you'll actually get pulled into these rules, and you need to report the transaction to CRA, and you have a timeline of 90 days to do that. So it's really important that you're understanding the types of transactions that you're entering into, because you will have to report that. And so it's not a good idea to just go off and say, oh, I'm going to do something with an investment advisor, and you don't really understand what you're getting into, or someone comes to you and promotes this great deal that's going to save you a bunch of money. You really need to understand what's going on and make sure you understand the obligations to report that.
Yeah, I don't want to
penalties.
point any fingers, but you know, I find that my clients who are doctors tend to gravitate toward deals and you know, word of mouth investments that are often very illiquid and sometimes quite a lot higher risk than they might think. But it's that, well, my friends have done this. I find this in the professional sports community as well. It's you know, my friend knows about a deal, I'm going to throw a large sum of money into this deal without really understanding what it's about and what the, you know, what it looks like under the hood. So the government doesn't like this either. You know, I know Lori can speak to this too. She stays away from deals. We're managing portfolios for retired Canadians for the most part, who don't want to take risk and you know, lose the capital, because once you've retired, you really don't want to be going back to work full time. Because your money disappeared or became unavailable suddenly. So now what the government's saying with these reportable transactions is, well, they don't like them either. They want to know what's under the hood. And not only that, before you actually do it, or within 90 days of implementing that plan, you have to let us know. It's quite a big onerous obligation on your tax advisor and you as a client.
And I'll just say, I know we're short in time here, but I'll just say this, is that it's a reporting obligation for the taxpayer. So you, doctor, there's a reporting obligation of the advisors and or promoters. So everyone has to be reporting. So it's kind of like a rat rule. One person reports, someone else doesn't. You know, you can get yourself into trouble. So it's really making sure you understand your obligations. Talk to your tax advisor. That was really important. The notifiable transactions, these are similar in the sense that, but these are really targeted at certain types of transactions that finance has said, we don't like you doing these things. And they're listed on their website to say, don't do this, don't do that, don't do this, don't do that. So those ones are very specific and they always will keep changing. So, but it's a similar kind of reporting mechanism as well.
Thanks, Troy. I'm going to move on. I had a question for you on trust, but I'm actually going to ask it of Michael because I know he can handle it. So thanks for joining us, Michael. In my day-to-day, I often get asked about the uses of trusts for my incorporated professionals. Can you tell me when they make sense and when they don't make sense, and what are the benefits to clients?
Sure. Hey everyone. Yeah, we see professionals using trusts, and there can be different reasons for that. One, for clients that I'm working with that have professional corporations, they own the shares, kind of similar to the diagram that Troy had in his slides. If a doctor is holding shares in his professional corporation and there's a lot of value flowing through there, and there's potential for a lot of growth over time, then that growth is subject to a capital gains tax in the future. So if the shares are sold or if on death. So if somebody passes away in Canada, then all of their taxes or their capital gains are triggered and become due and payable. And so if there's an expectation that there's going to be significant growth over time, where the capital gain is going up and up and up, and we want to plan around that, then sometimes what we'll do is we'll try to freeze the value of the company today so that you're locking in your gain today. We know what the tax is that way. And then you're taking the shares that are going to grow in value, and you're settling a trust, and you're having the trust take those growing shares going forward, so that now the growth over the next 21 years, these trusts have a lifespan of 21 years, will grow in the hands of the trust, and so they're not taxed in your own hands. Now we have a fixed capital gain that we can plan around. So whether that's going to be, if there's liquid funds in the company or elsewhere that can pay that in the event of death, then that's good. Or you're setting up a life insurance policy, and then the growth is in the trust. And for the next 21 years, you can control it as the trustee. You can decide who the beneficiaries of this trust are going to be, maybe family or extended family or whoever that may be. And then in 21 years, there's a deemed disposition that occurs for the trust where you really have to wrap it up. And at that time, what people will often do is if their kids are old enough, they might distribute those shares that the trust holds to their kids, and that can be done on a tax deferred basis. So now they've effectively just skipped a generation for a part of the tax, just assuming, if everything goes down a proper descendant line, that they're going to pass away before their kids.
So a couple of things that I heard you say there is, if I have enough value in an asset or a group of assets, whether it's investments or real estate, and I'm not too worried about owning and controlling the growth going forward, I can do an estate freeze and attribute all of the future growth to my children, who can then later decide if they need it or not. If they don't need it, they can give it to my grandchildren, my as yet unborn grandchildren. They can give it to my grandchildren, and so that decision can buy you more time beyond the 21 years. Because I often get asked, well, am I too young to do a trust with this 21-year rule that requires a disposition for tax purposes? I'm setting myself up for failure by setting it up too young. And I do know that everybody likes to hear that possibly, yeah, you're a little too young for this. But what would be a typical age that you think people should be looking at considering an estate freeze for the first time?
Right. Yeah, I think that it would be, you have to be considerate of how, if it's something that's going to pass down to kids, then you have to be mindful of, how old are your kids? If they're 2, 3, 4, then in 21 years they're going to be in their mid-20s, and is that too young to then shift ownership of a potentially significant asset into their hands? So in that case, we might be looking at setting a trust like this up when their kids are a little bit older. If the intent is to potentially shift the growth down a generation in the future, we might wait until the kids are a little bit older, so that when you hit that 21-year mark, you're potentially going to be more comfortable to put assets into your kids' hands. So maybe 10 or 15, where in 20 years from then they're going to be in their 30s, maybe a little bit more settled and established. And so I would say if that's the purpose of it, then that's probably the age bracket that we would be interested.
That's good. It's nice to have those goalposts. Troy, if I could get you to unmute, I'm actually going to bounce back to you. Could you talk about the tax consequences of missing the 21 years, and going back to your comment about maybe not planning ahead? If we get too close to that 21-year rule on a trust that's been implemented, and we miss the tax planning, what happens to a client's bottom line then?
It's bad news bears. That's all I can say. No, as you've alluded to it, Michael, you said this is the deemed disposition on 21-year anniversary of that trust, and essentially what that means is a disposal of the trust property, which again, often in the case is if it's holding shares of a private company, and that holding company's got investments, and that investment has grown over time, it could be a huge value, and the cost base of that is usually like a nominal amount, $1, let's say. So pretty much all the value is subject to capital gains tax. And so you're looking at, BC right now, like let's call it about 26%, 27% capital gain on that. So, that's big numbers if you're talking about, any thing really, but a million,
Especially
10
if it's a
million.
fixed asset that's illiquid, and you've got to pay that tax because it's been deemed to be sold, but not actually sold. You might not have the cash to pay that tax bill, but the government doesn't care about that. So now all of a sudden you're liquidating your other investment portfolios, and going back to the Lori in your life, saying, shoot, I messed up. So, just really keep your eye on the tax ball, have those annual meetings with your tax advisor for sure. You're obviously going to be meeting with your investment advisor on a regular basis because you want to know what's happening at least twice a year. Back to you, Michael. When you're looking at estate planning, maybe talk about the uses of wills in estate planning and what are the purpose of maybe having more than one will. I'm not sure that everybody who's attending even knows that you can have more than one will. Can you talk about the purpose of multiple wills and how that works?
Sure. I should start by saying I'm pretty sure that the audience is spread around through BC, Alberta, and Ontario, and so I'm a BC lawyer, and I can speak to this mostly through a BC lens, and I do understand to an extent how it works in Ontario and Alberta, but just be mindful that the rules might be a little bit different. So having multiple wills in BC, we see that where people have private companies where they're holding shares and value in private companies that's significant, then people will use multiple wills as a way to carve out that value so that you can bypass the provincial probate fees on it. And so probate fees is something that comes up when someone dies. It's an application that the executor of an estate has to make with the court in BC and in Ontario and Alberta for that matter, to certify that the will is a valid will. And when the executor makes that application, they have to disclose all of the assets that form part of the estate that are passing through that executor's hands and pay a provincial tax of 1.4% on the value. That's the BC. So if you have 10 million in your company, and then that's 10, the shares of that company are going to be subject to probate, and you'll pay about $140,000 in probate fees on it. So having a second
worse than paying probate in BC is paying probate in Ontario, which is 1.5%, and Alberta,
Ontario
you don't
is
have to
higher.
worry about it.
Alberta, you're okay. I think there's a flat rate for probate, so I don't think that the multiple will planning is very common in Alberta. No. In BC, we do see it. People do it for that reason, just to carve out that value, so that you don't have to pay the probate fees on it. And we also see it where people they have different ideas in terms of who they want to manage if they passed away, who they would want to manage the business end of their estate versus the personal end. So we would see people want, if they had different individuals or entities in mind for management roles, you could carve out that by having a second will and having those corporate assets governed by one will, with person A acting as executor and managing that business side, and then person B handling things through a separate will to deal with personal assets like real estate and investment portfolios and anything else that's personal. So people do it for that reason too.
So let's talk about what happens if we're not dead, which is actually an easier solution sometimes than being incapacitated. Can you talk about the plans that you put in place for incapacity and what the minefield that people often walk into without proper planning?
Yeah, it's really important to have a plan to cover that scenario as well. And sadly, we do see it where people don't have proper planning documents in place to address incapacity, and it could be a big problem. So the problem is this: is if you well, let me start by saying that the typical documents that people would put in place to establish a plan to have somebody manage their affairs is a power of attorney. That's for financial. That would be giving someone the authority to make financial decisions on your behalf. And with a power of attorney, in terms of dealing with professional corporations, that individual who's acting would then have the ability to vote on your shares of your corporation, to appoint themselves or to appoint another physician, for example, as director. To take over management of the company. So if you're running a clinic, or you have employees, or there's a business element to your profession, then it allows a smoother transition for someone to step in to take over control of management. If you don't have a power of attorney, then nobody can automatically just step into that role. So it could really interfere with management of the business. And if you don't have one, then the process to get someone the authority is through the court. So somebody has to apply it, and next of kin family member would have to apply to the court to gain authority as power of attorney, or in BC we call it a committee. And it's a really invasive procedure. So they have to take you to be assessed by 2 separate physicians to confirm that the person's incapable, and then it's a public court hearing to confirm, to deem that person incapable, and to give the applicant the authority to act as the committee going forward, or the adult guardian. It's also quite expensive.
Yeah, what I'm hearing you say is that it's something that you can get if you don't have a power of attorney in place when you need it, but it's going to take a lot longer and be a lot more expensive. So you're just leaving headaches behind when you could have very easily put in place quite a simple document to hand these powers over to somebody. I often say, from a financial planning perspective too, before you book that appointment with Michael to get your wills and power of attorney in place, is make sure you make use of the simple things like beneficiary designations on registered accounts, your RRSPs and TFSAs. And don't just name one beneficiary, have a backup to the backup. So make sure you're making use of contingent beneficiaries. And that is true for life insurance policies. Make sure if you're not leaving the beneficiary designation blank or making it your estate by default, because then you're going to pay probate, as Michael was talking about earlier. And we can avoid probate by the use of beneficiary designations, or even jointly held assets. So joint ownership takes care of the transfer of assets. Like sometimes the answer can be simple, and sometimes it's a bit more complicated than that. I don't see any questions in the Q&A, so I'm just going to keep on going with questions and make the most of my time with Michael. I guess, what advice would you give to a new doctor, a retiring or retired doctor, and maybe somebody who is at the end stages of estate planning? Is it quite different, or like just address the different phases of life and what plans that as a minimum they should have in place?
Sure. So I'll start with new doctors, and I'll kind of tie it in, Cindy, with what you just mentioned about the ability to use beneficial designations on registered accounts. So just one thing to kind of add on that. The one time when we would suggest to people not to designate a beneficiary is where they have minor children. So if you're a young doctor and you've got a young family, then and a spouse, it would make sense to and you wanted everything to go to your spouse. If not to your spouse, then to your kids. Then it makes a lot of sense to designate your spouse as a beneficiary, or a successor annuitant, I think they're called on certain accounts. That way, those accounts, as Cindy said, would pass directly to the spouse if you passed away, and that happens outside of probate, outside of the estate. So there's no probate. But then the other added benefit is federally there's a deferral, a spousal rollover on any federal income taxes on, in particular, RSPs style accounts. So, but beyond that, if you had your kids designated as beneficiaries, as kind of alternates, and they're minors, then what happens is if a spouse passes away first, and then you pass away, then the money, it does bypass probate, but it ends up being that you lose control. So the money now does not go through your estate. It's not governed by your will. It then instead goes to the public guardian and trustee, which is the government agency who handle things for minors. They take the money, they hold it until the kids reach the age of 19, which, depending on the amount there, could be a pretty young age for a potentially big sum to go to kids. And they also charge their fees on the money over all the years, and they charge substantially. So in those cases, sometimes we're saying, okay, well, yes, there's going to be probate if you have it go through your estate, but at least we'll maintain control, and you can establish trusts within your will for your minor children. And so just on what we would be suggesting to new doctors who have young families is you would have trust established in your wills to make sure that your kids, there's somebody looking after the trust funds for them, that you trust to look after them, and that it runs out to an age that perhaps will be a time when you're comfortable that your kids will be mature enough to take care of things themselves at some point down the road. Perhaps that's beyond 19.
We
That's new doctors.
are actually out of time. We've maximized the 60 minutes, but we're going to keep on going for anybody who wants to stay on. I've got a couple of questions coming in. So question for you, Michael, can a legal will kit, and for all of you who have made plans beyond this hour, thank you so much for joining us. We appreciate your time, and we will email you a copy of the recording in follow-up, and are happy to answer any questions that you might have on a one-on-one basis. So first question for you, Michael, can legal will kit documents for will, power of attorney, testamentary trust be just fine if done carefully?
It's a common question. I haven't seen the most recent will kits out there, but I have seen some of them. And I'll say this, so sometimes people can get away with just really basic, putting, fill in the blanks will kit style programs. But then other times it turns into a big disaster. And I've certainly had situations where people have passed away and they had a do-it-yourself will. And the problem is, the will itself may be just fine, but what's happening around the outside of the will, it could be problematic. And it's a look at how you own your assets, seeing what assets are governed by the will and what assets aren't. So perhaps if you do the will yourself, you haven't kind of had professional advice on, as things that Cindy had mentioned, how assets are owned. So owning things jointly, for example, certain assets might not even form part of your estate, and that may be the way that you want it, but it might not be the way that you want it. Or the beneficial designations might say that things are to go to one child, but maybe you have 2 or 3 kids, and the intent is really that it's to go to all of them. But now we haven't addressed that as part of the plan. So now the kids are upset, and there's litigation that's kind of brewing up because there's a lot of tension there. So having professional advice around the estate plan as a whole, I think, is probably the most important part. People come in and will do simple wills. It could be they'll do simple wills with us, and it could be that the will kit will be okay. But it's the roadmap to get there, to know that, okay, all the asset ownership arrangements have been put in place to ensure that this simple will is going to do the trick.
And I would say one thing to be mindful of is if you're using a template for anything, you might not be aware of tax implications by following that template. So it's not just the legal document that might be missing some things, but could actually be causing you harm. Another question, who is a good trustee for my trust? What options among professionals are available?
So just in terms of what I see, people, so if it's to act as an executor or a trustee, I mean, option 1 is a family member, I suppose. If you have a family member that's appropriate to do it and trustworthy, whether it's an immediate or extended, that's one. If you don't have a family member, then you could consider other individuals. Some people appoint friends, but then beyond that, people would be looking at hiring trust companies to do it, typically. So there are lots of trust companies, certainly in BC and Ontario, and actually Alberta as well, that take on this role of acting as an executor and trustee. And there are lots of circumstances where it makes sense to do that. So one being, if you have beneficiaries that don't get along well, and where it might cause more tension to have one of them acting as an executor and the other not, then you want to have a third party impartial entity step in, like a trust company. The other is where their beneficiaries are all outside of Canada, then it's not ideal to have a non-resident act as an executor or trustee. So maybe they'd be looking at a trust company to do it in that instance as well. And the other would be if they just don't want to put that burden. It is a big job on their family to take it on. Then we see a lot of people shifting to trust companies to take on these roles now, because it is very complicated to deal with an administration of these days. Yeah,
what I would add to that too is beware of bank-owned trust companies, because We've had lots of situations where they step in and say, well, if we're going to act as trustee or executor, we have to be managing the money. So all of your carefully laid plans, you know, where you've chosen your professional advisors, they're just going to fire them all and take over the management of those assets. It's a conflict of interest, quite frankly, but they somehow managed to get away with it. So on my side, I prefer to use non-bank owned trust companies that don't have a vested interest in managing your wealth and who actively work with the team that you chose to manage your wealth during that transition of assets. Good question. Thanks for that. Those are all the questions that we have. Thanks again to my wonderful panelists. You're excellent experts in your field. I really appreciate your time. And I'm sure all of our participants do as well. And we'll sign off and be talking to you in the very near future. To your success.
And thanks again, Cindy, for putting this together. We appreciate it as well. And I'm sure the listeners found it useful.
Yeah.
Very good.
Thanks, Cindy. Thanks,
Bye
guys.
now.
Thanks. Bye.
Thanks, Cindy.
Bye-bye.
Bye.